It's weekly. We have a great episode prepared for you today. My name is Sam Thompson, and again, as always, we're joined with Joe Bladek. And how are you doing today this morning, Joe?
Hi, Sam. I'm doing well. Thanks very much for that awesome introduction. I'm excited to be able to share episode 62 with all our viewers as well. It's been a great episode last week we had. And just going into some more detail this week on some things related to that. It's going to be great content for our viewers, as well as some of that regular data that we get out to all our viewers with what's happening with mortgage rates and real estate data.
Yeah, it's definitely it's awesome to be able to go through week by week and seeing the changes, keeping everybody updated because COVID has made the market very sort of unpredictable. So it's awesome to be able to try and find some trends of where things are headed and be able to share that with everybody.
We were looking at some of those trends this morning, Sam. We were looking at some houses that have been selling for over list. Yes. Bungalows that would sell for $300,000-$400,000 just a few years ago, now selling close to $800,000 to $900,000. So just massive increases and massive trend changes that we just like to cover here on Canadian Mortgage Weekly. So everyone that's buying a home can be more educated going into the whole process.
Absolutely, yeah.
Yeah, but with the weather, the way it's been, it has warmed up a little bit this week. Maybe that has had a little bit of a market change. I don't know what's going to happen today. The snow is back, but it seems like the spring market's just around the corner. Yeah. There's not many listings right now, which is really key. But that spring market, when all the listings do pop on the market, I think is just around the corner.
Yeah, absolutely. I mean, exactly like you're saying, spring's around the corner. I was out yesterday and it started to feel like spring. Everything's getting quite mild. You don't need as many layers when we're taking the dog for a walk. So it's been definitely nice, especially coming out of a January lockdown where everybody was trapped. Now we have some openings and restrictions and the weather's starting to get nicer.
Absolutely, Sam. And you know what? Even though the weather is nicer right now, it's not going to stay like that for the rest of the month. As you know, the Canadian winters, it goes nicer and then it goes way back to the cold and then it goes nicer. And then we got another snowfall and then it just keeps bouncing until maybe April or May sometime when we finally get rid of all the snow.
Yeah, exactly. What was it last week that was Groundhog Day and he saw his shadow? So we got 6 more weeks.
6 more weeks
to go through. So
yeah, that's right. Well, thanks to everyone for joining us today on Canada's weekly mortgage video news podcast, Canadian Mortgage Weekly. We're really pumped. Why don't we just get started on some of this data that's been coming to us this week, Sam?
Yeah, absolutely. It's awesome to have, again, like we're saying, a pulse on what's happening in the market and specifically something that really takes a lot of our attention because we see that a lot of the tracking is a 5-year fixed rate. So in looking at what the bond yield has been doing has been definitely interesting. We've seen definitely a tight range. I know that we had seen some activity even earlier in the week. I think Monday we reached 1.71, which was a high that we hadn't seen over the past number of months, but it has dropped back down. It's sitting at 1.68 at the moment. So we've seen it doing some like ping-ponging around in the 1.6% range.
Definitely have seen the ping-ponging you mentioned there, Sam. It's almost as if the market is waiting for some data to come out or hovering in that general space until some announcement for the next stage. And, I know we have our rate announcement coming up, which we'll cover a little bit later in the episode. And I know Omicron cases are dwindling, but there is other news events such as the trucker convoy in Canada that's causing a lot of disruptions. We're seeing our capital being shut down. We're seeing borders being shut down. So as long as that continues, I remember hearing on the rate announcement last time that it's the supply issues that need to be taken care of before any rate increases can go forward. Right. So I'm not sure if that's going to be one of those deciding factors, but we'll have to wait and see. We'll cover that on Canadian Mortgage Weekly.
For sure.
Yeah. But going on, we'll cover the bond yield here. It is tightening. We'll have to see what happens going forward. But let's take a look at the CDOR rate. Sam, I know that you follow that here with us at Canadian Mortgage Weekly. Tell us a little bit about that.
Yeah, of course. So the CDOR rate, we get a variance of it from what the prime is, just to get an indication of, is the variable rate a good option? We want to see the variance to be, at or below 2%. And as of the most recent data, it is up from last week. It's sitting at about 0.572%, whereas last week we saw it down at 0.536. So it may seem like marginal numbers, but we're still over 2%. So it's indicating, and the fact that we've seen a really small but relatively steady rise since the last Bank of Canada rate announcement, it has slowly started to increase.
Yeah, that's interesting to see. And we'll have to keep an eye and a pulse on this going into the next rate increase, because a lot of people have been taking variable rate mortgages. We did do an episode last year where we did mention that from our research, we did see that, actually from your research, Sam, that you were seeing 1/3 of Canadians were taking variable rate mortgages. And as of that episode that we recently did, there's some new research that's coming out that now it's down to 1/5 of Canadians are taking variable rate mortgages. We're just slightly below that. So
yeah. It's definitely something, I think to consider. We had seen the overnight rate from the Bank of Canada staying steady, but I think, hints or indications at a rate hike has definitely influenced, some maybe new buyers or refinancing just to get into a fixed rate to avoid any hikes.
So talking about rate hikes and what's happening with rates going forward, it's not up to us. It's not really up to the market for variable rates. It's really up to the Bank of Canada. And the last announcement, as we saw, Sam, Bank of Canada kept rates the same, which means that variable rate mortgages and all associated products have their payments stay the same. Now we have a next update coming up on March the 2nd. It's really going to be interesting because we have been talking about a rate increase in the spring for quite a while. This is getting very close to spring. The groundhog is not saying it's spring yet, but maybe the Bank of Canada will be that groundhog we're looking for.
Yeah, I mean, it's going to be really interesting because, the last time that the Bank of Canada had, lowered its interest rates to the overnight rate of 0.25% was back in March of 2020. They made a couple adjustments to it right at the start of the pandemic, if you can believe that we're 2 years from all of the initial news and excitement. But the fact that we've held that same rate, it'll be interesting to see 2 years later what the Bank of Canada is planning on doing. As you were saying, there's a lot of different considerations in their monetary policy regarding supply issues, regarding Omicron. But, with things looking like, there may be a silver lining on all of this. I know we've seen, is it Alberta and Saskatchewan that are beginning to lift restrictions? I know Ontario's not jumping into anything, but if we start to see things open up, it may even, like you're saying, indicate a likelihood of a rate hike.
Definitely will. I think that will be that message that's coming across, is that things are opening up, the economy is doing better, let's raise the rates as part of this whole opening up. So, I mean, there is a silver lining in the sanctions, the restrictions and all the COVID restrictions and the supply issues that we're having. And that's that the government is keeping rates low while this is happening. But let's just see what happens on the rate announcement on March 2nd, where we will be doing a special episode on Canadian Mortgage Weekly Live with a pre-rate show. Yeah, so looking at the next data point, we like to follow the house price average here on Canadian Mortgage Weekly Live. And with that, our data that we have is still from December of 2021 with the average house price of $713,500. We should expect the January numbers out in 1 to 2 weeks. And Sam, is going to be really interesting because we have a 17.7% year over year increase from December 2020 to December 2021. It's going to be interesting what January to January looks like.
Yeah, that's right. January typically, a bit of a slower month anyways, but not necessarily what we had seen in the past where, the spring market started very early and we had a very busy January, February. But yeah, it'll be interesting to see what the market stats are. I know we got, a little hint of an insight when we had our special guest, Shauna, on last week. We talked a little bit about at least the local market of Barrie. But this will be interesting to see. Like you're saying, I think usually it's the second or third week of the months that we get the previous month's house price average. So again, hopefully we'll have some more accurate numbers for you in the terms of house price average. But again, year over year of 17.7% is quite strong. That's that third income, right? When you have that house appreciation, it's working hard for you. Yeah, it's quite a number when you look at it year over year.
Quite a number for sure, Sam. Quite a good return for an investment if you're looking at it that way. I know a lot of folks invest in mutual funds and in stocks and bonds. It's hard to find a return of 17.7% on your investments when you're looking at those vehicles. So I've always enjoyed real estate as an investment for the reason that the returns have been proven year over year. However, there's a lot of folks right now with the house prices where they're at today, they just can't even afford the houses. So we're seeing that folks with full-time incomes, with good savings, with perfect credit and no debt are coming to us wanting to buy a home in their local market. And whatever they're doing the right things that they've been taught, because that's what you're supposed to do. Save your down payment, don't take on debt, and have a good credit score. But that's no longer enough. No longer are you able to apply for a mortgage and secure a home with simply one income these days. And it's getting almost impossible to do it in any urban center in Canada, even if you have two incomes. So with that, today, as you know, Sam, I wanted to dive into the 32 types of unique incomes that we deal with on a regular basis as mortgage professionals. And here on Canadian Mortgage Weekly, Sam and I will go through each one and just tell you a little bit about it. And please use this only as a guide and contact us privately or through direct message if you like to talk about your specific scenario, as certain lenders may want to see alternative documents than what we will mention today.
Yeah, it's going to be a great episode. I mean, 32 types of unique income. This is definitely probably one of the more common questions. Obviously, if it is a full-time income, you're receiving your T4, you're either on a salaried income or guaranteed hours per week. It's much easier document-wise and process-wise because it is very straightforward. But as you're saying, sometimes it doesn't cut it. We had chatted, I don't know if it was a few weeks ago, about, maybe the necessity of a side hustle, some sort of side income, which usually they come from unique streams. It's not usually a straightforward process. So it's going to be great to hop through and look at, what would be required or a little clarification on these different types of income.
Exactly, Sam. As you know, full-time income being the number one income we usually run into. That's if you are salaried or full-time hours at your employer. That's a pretty simple verification to be done. So we're going to focus on all other incomes today. And Sam, what do we have up first here today?
So the first one we're going to chat about is going to be part-time income.
All right. So as we know, with part-time income, it is difficult to verify your employment because a lot of the times part-time employees don't receive guaranteed hours or consistent hours or a consistent schedule. So that does become a little bit of a risk to the lender, especially if that person is newly employed. So with that, Sam, usually in this case, we can use the income if the hours do vary on a week-to-week basis, so long as that person's been there for 2 tax years and can provide 2 years T4 slips showing their income for each of the previous 2 years. If the hours are guaranteed in writing, say via a letter from your employer saying that you work at least the minimum amount of hours each week, then in that case, typically we just need to be past your probationary period to use that income.
Mhm. Yeah, and I know that some of the lenders also may want to see your most recent pay stubs to confirm your year-to-date hours, just to make sure that it communicates the same thing as your letter communicates.
That's a very good point, Sam, especially if we're looking into your file, September, October, November of that year, because there's been almost a whole year that there hasn't been a T4 slip. So the lender will want to make sure that you're on track to hit the same hours. But yes, do give us a call for that one if you have any more specific questions. And we have 31 more types of income to follow.
Yes, and pressing on to the next one is similar vein, but it's going to be anyone who has casual income.
And with casual income, that's a little bit like part-time income, but also very different, because casual could mean that you're working 1 week full-time and you're working no hours the next week, and maybe part-time hours the third week, and then maybe you're off for 3 more weeks, and you're just sort of showing up when you feel like, and the employer is not really guaranteeing you anything, just that they will contact you when work is available. In these cases, and correct me if I'm wrong, Sam, a lot of the times for most mortgage files, we would need to see 2 years T4 slips for this type of income to be able to use anything.
Yeah, exactly. I mean, and the biggest thing that you're talking about is the inconsistency where, sometimes it is full-time hours, but it's not a reliable income source. And that's where the lender likely is going to require that 2-year tax return so we can track an approximate amount for the full year. It's harder for those types of files to, extrapolate 1 month of payment, which could be irregular, either irregularly low or irregularly high.
That's absolutely right. So moving on to the third type of income, what do we have up next?
And third, we have contract income.
Contract income. So if we're looking at contract income, a lot of these contracts, they tend to be for a specific amount of time. A lot of times we see contracts that are 3 months in length, 6 months in length, 12 months in length, some are 24 months in length. The key thing here you want to make sure of is ask this question to your employer: is the contract renewable? And is that something they can guarantee in writing? And from there, we can take a look at what is next, because for contract employment, it can be very different for each employer. And in this case, you really need to send us a little bit more information.
And I know that it also can help if you know that your contract has been renewed in the past. That can go a long way as well, just showing that the employer has already renewed it previously. And exactly like you're saying, Joe, if the employer can clarify for you whether it's renewable or a non-renewable contract.
Exactly. Great point, Sam. So moving on to the next type of income.
It's going to be anybody who is an independent contractor.
Independent contractors. So for anyone in this position, you're technically not really employed by one specific entity. You're self-employed in a sense that you're working on your own, maybe for 1 or 2 or 3 people, depending on where you're at. And a lot of the times in this case, it could include commission and hourly income. And most lenders will look at this as self-employed income. So in this case, you will need to provide 2 years tax returns to be able to use that income for most situations.
Great point. And it does lean into the next type of income to chat about, which is self-employed income.
So for self-employed income, very straightforward. And yes, it does include independent contractors in this case, but self-employed, if you do run your own business, say you're a sole proprietorship, or you have a corporation, or perhaps you just run something out of your basement and you don't really have anything set up, but you do collect money for your services. There's a lot of different ways we can do those mortgages, but typically the lenders do want to see you in business for at least 2 years if you're purchasing with 5% down. Or if you're purchasing with 20% down, there are some lenders that will look at your 6 to 12 months bank statements instead of your tax returns to look at your income. But again, it's really a case-by-case scenario, isn't it, Sam? Because we've seen lenders ask for varying documents if that person is self-employed.
Yes, it definitely does depend, exactly like you're saying, what degree you're self-employed, and a lot of those different factors. And it leans into the next income factor, which is business for self. I mean, I know that, these past few ones have gained more traction, with people already working from home. Maybe they're able to, start an Etsy. They like knitting anyways. They're going to start knitting hats and selling those. In order to count this income, a lot of these rules are apply so that we can use this income.
Exactly. I would say the same rules apply for business for self as do for self-employed as well. Yeah. So with that, typically tax returns or bank statements, depending on the amount of down payment. But the lenders do like to see some sort of stability. So if you are selling Etsy, they'll want to see more than, the occasional transaction. They'll want to see that your Etsy store is moving along in a positive direction.
That's right.
Yeah.
And
so what do we have next?
Yeah. So this is if, maybe you started self-employed and it got big enough to the point that it is corporate income. You have gone incorporated with your business.
That's a great place to be if you've gone incorporated with your business, because then your business becomes its own entity and can be its own person. So you can file taxes on behalf of the business and on behalf of yourself. In that case, you will, in addition to the 2 years tax returns or the bank statements that you will need to provide, depending on your down payment situation, you will also need to provide what's called articles of incorporation, which is just showing who the shareholders of your corporation are. Could be just yourself, or you and a partner, or you and a spouse, or you and many other people. Fact is, the lender does need to know that to be able to assign a value to you to be able to underwrite your mortgage. So these are quite a bit of unique income so far we have, Sam. What's next on the list?
The next one is anybody with any Wsib income.
Now this one's really interesting, Sam, because Wsib income is not taxed with income tax in Canada. So it's a unique income in the sense that a lot of lenders will allow you to use more than what's stated on your Wsib income letter. So say if you're earning $30,000 in WSIB benefits, the lender may be able to use 35 or 40 or even 45,000 as your income amount, depending on that lender policy.
Wow.
In this case, though, typically what we need is a letter from the WSIB provider that you're with, and bank statements showing that you've been regularly receiving those deposits. Moving on to the next type of income, Sam.
Yeah, the next one is something that we see commonly, maybe if it's a co-signer, is somebody who is receiving CPP pension income.
That's right. We see a lot of those coming from our co-signers because they're parents and they're retired, or even those who are retired and looking to downsize and they just have a CPP pension income. In this case, you're issued a T4A slip from the government, and we will need to see the last 2 years of those, as well as your most recent CPP letter that you get. You get one every year, as well as bank statements confirming the CPP deposits. Yeah.
Often partnered with the CPP pension is also an old age security income. Typically, we see a lot of those files coming in with those two types of income.
Exactly. Typically, if someone is receiving CPP, they've also started receiving old age security, typically short formed as OAS. And with that income, similar type of situation, your T-slip from the government for the last 2 years to make sure that you've been receiving that income, and the most recent bank statement showing that you are receiving those regular deposits from old age security. Yeah. What is next on the block? Because we're going through this list pretty quick, but I'm not sure we're going through it quick enough based on how long our episodes usually are, but it's okay. We'll have an extra long episode today.
Okay, awesome. Well, going on, we have anybody who's earning commission income.
Great. Commission income is a unique situation because a lot of the times commission income can either be taxed through your employer, or you can earn it as a self-employed person. So there's two different ways you can earn commission income. So let's talk about if it's through an employer. If it's through an employer, you're going to need an employment letter and pay stubs and 2 years T4 slips showing that you've been receiving this commission. And we'll take a look at the last 2 years to assess how much of it we can use with the lender. Some lenders allow more, some lenders allow less. And that's just how it works. And if you are guaranteed a commission, then you will need to have that in writing on your employment verification letter. Otherwise, we won't be able to use the current amount. We will only be able to use the historical commissions you received in the last 2 years. Any questions about that, please give us a direct message. There's many ways we can qualify your income. We're going through and giving you the main practices the lenders talk with us about. Keep in mind, there's cases where the lender could ask for more documentation just to help verify what is presented.
Mm-hmm.
So what do we have next there, Sam?
Next on the list, we are looking at anybody with interest income.
Interest income. So that is great. And this is something we talked about. Maybe someone's won the lottery or has a big inheritance and they've invested that and are living off the interest from that investment. Which would be nice, wouldn't it?
It would definitely be nice.
Yeah. In this case, there's two different ways a bank can verify this. One way, if you do have a large amount in your account, there are some lenders that will provide an equity mortgage based on the amount on deposit in your account. However, this is more interest income. And in this case, we'd be looking at what is your interest earned over the last 2 years. And again, we'll look at the last 2 years tax returns in this case to ensure that we've correctly identified your interest income. A lot of the time you will get a T-slip from your or tax slip from your investment provider, but sometimes you won't, and you need to report that income on your own. What do we have next there, Sam?
Next on the list is something we've seen, some more increase in as people are diving further into side hustles with anybody who's maybe employed at Uber or has a skip the dishes account, all of these as drivers.
Exactly. This is a really neat program because like you're saying, I've seen a lot of these applicants and some of them are earning 20, 30, 40,000 in income a year in addition to their current full-time position, just working nights and weekends. The key thing to remember, everyone, with Skip the Dishes, Uber Eats, DoorDash, DoorDash, or any of the other providers that you're driving for, you need to make sure that in this case, the lenders will want to see a 2-year history of your total income from these providers. So it almost falls in under self-employed or independent contractor, or in this realm for the lenders, in the sense that you will need 2 years tax returns. And that is for pretty much every single lender. And just moving on. Yeah, it is great. So anyone of you who are doing Skip or any other delivery and you've only been doing it for 6 months, keep at it. You will be able to use that income eventually.
And moving on, we have anybody who is earning any rental income.
Yes, rental income is a very favorable income looked on by the lenders. Lenders do have a spot in the mortgage application specifically for rental income, which is nice to see. And every lender has a different calculation on how much they use. But in this case, to be able to use it as a client, you'll need to provide typically signed leases. If the leases have expired, you'll need to provide a tenant verification letter saying that the tenant is still there. You'll need to provide bank statements showing the tenant deposits. You'll also need to provide mortgage statements and tax returns for the properties you own as a landlord. And obviously tax returns for yourself to make sure that the income is reported correctly. And on those tax returns for the last 2 years, the lenders will also see the costs and the expenses associated with your rental property. And in some cases, some lenders do actually deduct the high costs from your rental application for your mortgage application. So it's good to work with a broker who understands the different lenders and which ones do prefer to work with property investors and which ones really don't have a good policy for that sort of mortgage.
Yeah, and the next one that we have, which again is very interesting, similar vein, but also treated quite differently, is anybody who earns Airbnb income.
Yeah, exactly. Airbnb income is a totally different animal for lenders. It's not looked at as rental income. It's looked at as self-employment income. Your full house cost will be counted of the property that you're using. And also they will want to see your last 2-year history for this Airbnb. Now, what we're seeing is a lot of people that do run an Airbnb don't really report the income on their tax returns, which prevents them from being able to use it. So make sure you do report it on your tax returns so we can use that income for qualifying purposes.
That's awesome.
Yeah. So what do you have next?
Next on the list, we have Odsp Income.
Okay, great. So Odsp income is an income that is not really readily accepted by most lenders in Ontario, simply because it is a benefit that is from the Ontario government, and it is it's hard to use this income because if anyone that is on this benefit earns income outside of this disability program that they are earning income in, their benefit income actually goes down. So it's very fluid in that sense, and that's why most lenders don't prefer to use it. But there are lenders that do use it, and in this case, they will need Odsp pay stubs, bank statements showing that it's been provided, as well as a letter from Ontario Disability Support Program confirming that you are receiving this benefit. Talk to us if you would like to use this benefit. What do we have next?
Plugging along, and the next one that we have is the Ontario Works Income.
In this case, Ontario Works Income, it is an income provided by the government of Ontario as well. It is a benefit. However, it's not a permanent benefit. And because of this being not a permanent, long-lasting benefit for anyone living in Ontario, it's meant to as a temporary stopgap. It cannot be used for any mortgage qualifying purposes. Okay.
Moving on to some very specific pandemic incentives, we're looking now at the CERB, or the Serb Incentive.
That's right, the Serb Incentive, which was presented by the Canadian government in 2020 as a response to the COVID-19 pandemic. I think everyone that lost work or had an issue in their employment or income could apply for it. And in this case, for the Serb income, the CERB specifically, a lot of lenders did allow us to use this income to fill in the missing income from their employers or self-employed providers. However, that's not the case for the next income.
Yeah, and the next income is the CRB.
The CRB, which replaced the CERB, cannot be used for qualifying purposes whatsoever because this is a temporary program and not available to everybody. So that is why we cannot use that one.
Next up on the list, we're going to look at dividend income.
Wow, we're just blowing right through this list, Sam, and it's a really long, expansive list. We could have almost put this into 2 parts. But looking at dividend income, we can use this as well. Again, this is usually a 2-year average. So in this case, you will receive a T5 slip for your dividend income. So we will need the last 2 T5 slips, as well as 2 years tax returns showing your dividend income, whether it's coming from investments or a corporation, it doesn't really matter. That is the starting point of where we would need to start with that income.
Next up, we have capital gains income.
Capital gains. Capital gains is a really interesting income because not everyone has it. You only really are earning capital gains income if you're selling something for a profit, like a house or a car or maybe a big asset, and you're reporting this on your tax return. Maybe you're selling some stocks, bonds, Bitcoin, and also reporting that as a capital gain on your tax return. Capital gains are hard to use because they don't happen every year. However, if you are a person that does receive capital gain income every year, we can look at using this on an exception basis with the lender. We typically need 2 years tax returns and an idea of where this income is coming from and a story to find out if it is sustainable going forward. All right.
For anybody who has any big families, let's take a quick look at any CCB income.
CCB income. So that's Canada Child Benefits. And in this case, everyone in Canada that's a parent does receive Canada Child Benefit as long as you're filing a tax return. And you do receive it for children under the age of 18. And with this, typically we are able to use that benefit with most lenders. In that case, we will need your Canada Child Benefit Assessment Return, the most recent one for the most recent year, as well as bank statements showing the deposits, and as well as birth certificates for your children, proving that they are under the age of, I believe it is 13, because we need to make sure that you will receive this benefit for the following 5 years for your mortgage.
Right. Mm-hmm. Moving on, something that parents will receive as well is the Ontario Child Benefit, or the OCB.
Good point, Sam. So that's a very small amount compared to your Canada Child Benefit. Typically, if your Canada Child Benefit is $500 a month, your OCB could be $50 a month. However, this is an income that we cannot use for mortgage qualification purposes. It's only the Canada Child Benefit portion we can use. Yeah, it's too bad. But moving on.
And moving on, the next one we have coming up is any adoption subsidy.
Adoption subsidies are an interesting animal because adoption subsidies are available to you if you are in the process of adopting a child, typically from, say, the Children's Aid Society. And I know we've done a few clients like this. And in this case, it's typically, again, historical income that is analyzed. And we're looking at the last 2 years. We'll need a letter also from the Children's Aid Society or provider of the income, and as well as bank statements confirming this income and how it was deposited for the last typically 24 months. So again, a lot of paperwork, but if you are going through an adoption process, the adoption subsidy can give you quite a big boost on your qualification.
That's right. Yeah. Yeah. And if you're in the process of adoption, or maybe you're even fostering, you might have foster income that we can use as well.
Yeah, it's a great point, Sam. This one's almost the same as adoption income, but still, we do need to take a look at a 2-year history again for foster care income, as well as a letter from the Children's Aid Society or department providing the income, as well as a historical 24 months of bank statements showing the deposits for their children that you are fostering. We are looking to make sure this is a sustainable income and that as a foster family, that you're able to maintain that income in some way over the last 2 years. Yeah, great incomes today, Sam. We have gone through quite a list here. Do we have any more left?
We have just a few more left here. So let's chat quickly about life insurance annuities.
Fantastic. Life insurance annuities. This is an interesting one because if you do hold a life insurance policy, typically the life insurance policy cash value will grow as you own the policy. Now, these growths, can you use them as income? Are you able to use those funds for any qualification purposes? And for down payment, perhaps, but for income, no. We won't be able to use life insurance annuities for that. However, if you are receiving life insurance payments, which is in cash, and you're receiving them monthly, do reach out to us because in certain circumstances, we can use income on a soft check basis, meaning that if we're looking for an exception, perhaps you have enough income from other areas by showing that you also are receiving life insurance annuities, we can help boost your application, but not really necessarily use it for qualification purposes altogether.
Next one, we only have 5 left to go through here, is going to be cash income.
Cash income. All right. So for cash income, and this typically, I'm assuming, means under the table income, income that's not really documented between the employer or yourself, and you're really not depositing this income into any bank account. You're taking it home. Maybe you're keeping it under your mattress or in your safe. In this case, no one knows what's going on except for you and the employer. and there's really no way to document this. The bank's not going to want you to take an iPhone picture of your stack of cash. No, they won't want to see your employer giving you the cash to you. That's not the case either. They'll want to see at the very least that you're taking this cash, depositing into the bank account on a consistent basis. They'll also want to see that you're reporting this cash on your tax return and paying income tax on it. If that's not happening, unfortunately, we cannot use that income.
Has to stay under the mattress, unfortunately.
Stay under the mattress. Maybe you can use it to purchase some candy at the store or something like that.
That's right. And the next one we have is for anybody creative or Pinteresty at all. We have anyone who flips or restores things through flipping or restoration income from Kijiji.
Yeah, that's a great one there, Sam, because we have had clients that have done that before and they have bought houses successfully. And again, the key thing here is to make sure that it is documented through some sort of bank statements. And if we can provide bank statement history, there are lenders that will look at common sense lending in this case. Typically, though, for common sense lending, we do need a down payment of at least 20% in this case to enter that field. So again, contact us if you are flipping things on Kijiji for further conversation.
And next on the list is affiliate income.
Yeah, so affiliate income, that has really taken storm the last few years, especially with online commerce. Affiliate income is simply you have a blog or a YouTube channel or a social media account where you promote other companies' products and you're an affiliate with that company. So you're earning a commission on products that are purchased through your affiliate links. Now, this is a really interesting income, but at the same time, it's also considered self-employed. And if you are earning income on social media like this, we will need a 2-year history of tax returns to purchase a home with less than 20% down. However, if you do have 20% down or more, there is a chance. Now, again, this is a new type of income, but there is a chance that we could look at the last 6 to 12 month deposits and go from there.
Now, the next two can likely be kind of lumped together as we look at income received from anybody offering lessons and also tutoring income.
Again, very, very interesting. This will depend on if you're employed or running it on your own. So if you're running it where you yourself are the person that is receiving the cash or the payment from the person taking the lesson or the tutoring, and you're running it as your own business, then we'll need to see 2 years tax returns. If you're working for a company as a tutor or as doing lessons like music lessons, if that company is able to write a letter saying that you're guaranteed a certain amount of hours or income, we could do it that way. But typically these are folks that are running their own show, their own business, and they are requiring 2 years tax returns in this case as well.
And getting to our final income number 32 is going to be something we chatted a little bit earlier in the episode, which is house appreciation.
Oh, geez. House appreciation has really been a high income for 2021. We've seen houses appreciate quite considerably. And we've always talked about, how houses, if a married couple owns a house, the house itself is a third income provider. So looking at the average house price of $713,500 and a year-over-year increase of 17.7%. So if we apply that, so it's looking at it here, 17.7%. I can't figure this out right now on live. I'm not sure where my math skills have gone. However, 713,000, that would have equated to income of just over $100,000 in appreciation. So, it's interesting to see it that way, how houses are appreciating almost on the same level as someone earning an income for an entire year. So in this case, can you use that appreciation as income for your mortgage qualifying? Well, not really. However, in terms of the amount of equity you have, If you are at a situation where you do have enough equity in your home, there are lenders that simply won't even care about what income you're at because there is enough equity in your property. So in those cases, it's best to contact Sam or myself and just start a discussion as to where you're at. And with that, Sam, you've been a mortgage agent with Mega Mortgage. I know we just merged with Verico Lend at Ease. So yeah, you've been with us for almost 2 years now. We were just talking about how the pandemic has been almost 2 years. I think we're looking at mid-March when that pandemic wave started to hit us. So we're almost there, about a month away. But yeah, you've been here in Barrie, moved here about 2 years ago from Ottawa. It's great to have you on the program today, Sam.
Yeah, thanks so much for having me, Joe. We covered a lot of awesome information. It might have felt fast to you guys, but it is a lot of information. And as Joe was saying, definitely reach out for more specifics. And just to introduce quickly, Joe Bladek, well, he just did the ringer of 32 different incomes back to back. So there's no shortage of knowledge that Joe has in the mortgage industry. You've been in the industry over 11 years, living up in Aurelia with your wife and kids. So thanks for being on the episode, having me here and covering off all this awesome information.
Thank you, Sam. Remember to join us next week on Canadian Mortgage Weekly, Canada's weekly video mortgage news podcast, where we'll be talking about extended borrowing. So perhaps you are a buyer in Canada looking to purchase a home, and everywhere you're going to, you're being told that you cannot afford a home. Well, if you have 20% down at the very minimum and have only explored the typical big five banks, you will not want to miss next week's episode because there are another plethora of lenders in Canada offering very, very competitive interest rates for extended borrowing for anyone that has at least 20% down on their purchase. And we're able to take these clients and sometimes increase their borrowing power by 10, 20, and sometimes up to 35% on what they're being qualified at the big five banks. So stay tuned for that episode. And if you have any questions before that, send us a private message. Thanks for watching today for Canada's weekly mortgage video news podcast on Canadian Mortgage Weekly.